think the fundamental fact is that people have been very negative on the outlook for the economy in the U.S. and around the world, and things are coming out better than people had forecasted. There were a lot of people talking about an earnings recession, and people talking about second quarter earnings were going to be down. They're not going to be down. Expectations were very low, and that can be a very good time to be an investor.
What about the back half, Charlie? Because this constantly happens. No one thought we were going to get a 3% first quarter GDP print, but then they all say, oh, there's going to be give back next quarter. No one thought we might avoid that kind of dire earnings situation for the first half of the year, but they say, well, just wait till the back half.
No, people have been saying that for 10 years, Kelly.
Right.
People have been saying that this rally is overrun, has been going on too long for a long time. Remember all that new normal, lower for longer,
secular
all that
stagnation.
Stuff that we used to hear?
Yep.
Yeah, and the inverted yield curve that's never been wrong in predicting a recession. Hey, it's going to be wrong this time. Fundamentally, the U.S. economy is growing. We have record low unemployment. We have wage growth for the first time in a long time. We have a better regulatory environment. There are a lot of positives. And the people that are pointing at negatives are talking about reduced growth rates in China from 8% to 6%. That is not the same thing as negative growth rates. So we're doing all this, and I'm sorry to be so enthusiastic, but we are doing all of this in the face of a very strong dollar that's actually depressing earnings from what they would actually be in local currency. So we've just got a very good earnings outlook.
And yet, Alicia, the reason I think this is so fascinating is we're talking about this now being the backdrop. We've already gotten the economic data for the month largely better than expected. The earnings data is coming in, and I hate to use the term better than expected there. It's a little bit different, but it's not the negative, the numbers that we thought we might see. So yet we're talking about a Fed that's going to cut interest rates next week. Is there really an emergency that they need to respond to out there?
That's a great question, because the truth is the fundamentals don't seem to really call for a rate cut. And what's really happening is that the Fed is letting the market lead it to a cut. So there was the opportunity for Jay Powell to push back against market expectations, and he chose not to. And so therefore, in a sense, the Fed is in a box and has to cut. And the reason that the inverted yield curve is not going to be predictive this time is that the Fed's going to get rid of the inversion on the front end by cutting rates. And, we expect a 50-point cut by the end of the year, probably not July, but certainly by the end of the year, in order to get rid of that inversion.
It's more of a you think they will as opposed to a you think they should? Or is it important that they do that in order, if nothing else, do you think they're just responding to the yield curve and saying, oh, we're going to fix that?
I think they should now. I don't think the fundamentals of the economy necessarily required it here. Particularly the data that we got for June certainly shows that whatever soft spot we had in April and May really turned around and picked up a bit in June. And so the trajectory is a bit different globally as well, by the way. So it's not clear that fundamentally it's required, but the markets need it right now. And to the extent that the Fed has let that go on and not push back, the Fed has to cut.
So finally, for both of you, Charlie, real quick, if you can, what are your picks? I mean, what do investors do here? I assume you tell them to stay away from fixed income.
Yeah, you stay away from bond substitute stocks because interest rates are still historically low. 2% is not an attractive level. Don't own REITs, don't own MLPs, don't own high dividend paying utilities. I still think there are a lot of cyclical stocks that are trading at 10, 11 times earnings that are at great value.
Okay, and I know you like CBS and Viacom too, Lazard for different reasons. Alicia, quickly to you, what would your recommendations be?
I'm in agreement with Charlie. You go cyclical here. The semis are telling you that there's a cyclical uptick coming, and so you go with that. So you go with tech, you go with consumer discretionary. Also stay away from the high dividend paying stocks, and also healthcare. It's in the crosshairs politically, Republicans and Democrats. You can buy some of the high throughput, genomic stuff, but that's it. The biotech companies, the pharma companies are in trouble.